Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. The stock market often feels like a crowded, noisy room where everyone is shouting about the latest crisis. Whether it's a spike in oil prices or a geopolitical conflict across the globe, these headlines are like flashes of lightning in a dark forest, startling, blinding, and enough to make anyone lose their way. But successful long term investing isn't about having the fastest reflexes, it's about having the clearest vision. To survive the shocks of the world, you need to separate the temporary weather from the permanent climate. Now, value investor Bill Nygren has a brilliant mental tool for this, the 7-year telescope. When a geopolitical crisis hits, stop looking at what the company will earn next month. Instead, try to project what the company will be earning 7 or 8 years from now. Why does this work? Because in the short term, stock prices are driven by voting, the collective emotions, fears, and panics of millions of people. But in the long term, the market is a weighing machine. Over 7 years, the noise of a border conflict or a temporary supply chain glitch fades away, and the stock price is forced to align with the actual cash the business generates. By the time 7 years pass, most great businesses have adapted, innovated, and grown right through the crisis. Now I know what some of you are thinking. Rahul, projecting earnings 7 years into the future sounds like guesswork. I'm not a fortune teller. Well, if forward looking projections are not your cup of tea, there is a second way to reach the same goal. Instead of guessing the future, you look for resilience in the present. A resilient company is one whose DNA is built to survive any 7-year period, regardless of the macro weather. We define a resilient portfolio by 4 specific properties that act as a survival kit for your capital. Low volatility, 10-year beta over Sensex of less than 1. These stocks don't panic when the market does. They provide psychological stability to help you stay invested. Number 2, fortress balance sheets. Latest debt to equity ratio of less than 0.5. They are not beholden to banks during a credit crunch. Debt is the biggest killer of companies during a crisis. Eliminating debt eliminates that risk. Number 3, proven discipline. A consistent 10-year dividend track record. Well, this is the ultimate truth serum. A company can fake earnings, but it can't fake a decade of cash hitting your bank account. Last but not the least, reasonable valuations. A trailing 12-month price to earnings of less than 30 times. Even the best company is a bad investment if you pay too much. We ensure we are not buying at the peak of a bubble. Now, the stocks that cleared all the 4 filters were then chosen based on market cap. That is, the one with the highest market cap will be our stock number 1, then the second highest market cap, and so on. This is not just theory. We backtested this exact resilience strategy to see how it handled real world shocks. Between December 2019 and December 2025, a period that saw a global pandemic and multiple geopolitical crises, this resilient portfolio returned 3.3 times. Now, some might ask if this success is a fluke. Well, I don't think it's fluke because there is a method to this backtesting. This outperformance happens because the strategy eliminates human bias. It stops us from falling in love with story stocks and forces us to choose only the highest quality companies at reasonable valuations. By sticking to cold, hard data, we remove the hope and fear that usually destroy investor returns during a geopolitical crisis. Now, when we run these filters today, we find a list of names that have historically stood tall. I'll share with you 10 out of the 20 names. The rest, I encourage you to find yourself. Here are the 10 names: TCS, Infosys, ITC, HCL Tech, ONGC, Coal India, Hindustan Aeronautics or HAL, Bajaj Auto, Wipro, and Tech Mahindra. Now look closely at this list. You will notice that 5 out of the 10 names come from the IT industry. This presents you with a critical choice, a crossroad that separates a rule based investor from a reactive one. Now you have two options. You can intervene manually and change these names to some other companies from some other sectors because of the perceived AI threat, or you can let the system do its job without bias. Here's the reality: if the fundamentals of these IT giants actually deteriorate, or if the volatility, which is their beta, starts to spike, the screener will automatically eject them at the next rebalancing. I'd like to mention the rebalancing here. The rebalancing period is 1 year, where you invest in the group of 20 stocks at the start of the year and then sell them at the end of the year, and then again start the process all over again. It's a self-correcting mechanism. Now I'll be honest, sticking to the plan is harder than it looks, but earning market beating returns was never meant to be easy. In the pursuit of alpha, you can just as easily underperform as you can outperform. If you're looking for average market like returns, index funds are a perfectly fine choice. But if your goal is to beat the market, you have to be willing to make these tricky counterintuitive choices. History shows us that this resilient screener has delivered in the recent past, and because its internal logic is rooted in financial discipline rather than hearsay, there is a strong chance it will continue to work in the future. So, in conclusion, whether you use the 7-year telescope to project earnings or the resilience scanner to find fortress companies, the goal is the same: stay clear headed. In a geopolitical crisis, most people fight over the next 7 days. You are positioning for the next 7 years. Well, that's all from me today. I'll see you again in the next session. Goodbye and happy investing.